Imagine waking up, checking your phone, and seeing the headline. Oil hits $150 a barrel. You don't even need to read the article. You can already feel your wallet getting lighter, your summer road trip shrinking. And that guy on Twitter yelling about stagflation again. Meanwhile, gas station signs across America quietly flip from expensive to, "Are you kidding me?" As the war between the United States and Iran escalates in real time, as of mid-March 2026, we're not at 150 yet. But Brent crude has already blasted past $100 a barrel after U.S.-Israeli strikes on Iran. And Iran's retaliation around the Strait of Hormuz choked off a huge chunk of global supply. So the obvious question is, could this realistically go all the way to 150? Or is that just financial clickbait with better thumbnails? In this video, I want to walk you calmly through what's actually happening in this Iran-US conflict. It's feeding into oil markets. What $150 oil would actually mean for your life and the broader U.S. economy. And most importantly, what a realistic path forward looks like. We're going to keep the pacing steady, the tone relaxed, and the analysis grounded. Think of this less as doom scrolling and more as having a long coffee with that one friend who actually reads the footnotes. I'll also make a few sarcastic comments along the way. Because if we can't joke a little while watching commodity markets melt down, what are we even doing here? Let's start with the basic setup, because none of this makes sense until you zoom out to the geography and the shooting. At the end of February 2026, the United States and Israel carried out major strikes on Iran. This includes operations that took out key leadership and hit military targets, triggering a wider regional crisis. Iran responded in the one place where it can really hurt the global economy fast, the Strait of Hormuz. It is that narrow passage between Iran and Oman that looks tiny on the map, but moves roughly a fifth of the world's oil and a big chunk of its liquefied natural gas. When Iran moved to close or severely disrupt that corridor through direct threats, attacks on shipping, and making insurance companies suddenly very allergic to the phrase transiting Hormuz, it effectively pulled a huge emergency brake on global energy flows. The result has been the largest supply shock the oil market has ever seen. Estimates suggest production and exports from Kuwait, Iraq, Saudi Arabia, and the United Arab Emirates collectively dropped by millions of barrels per day within days, with total lost output from the region climbing above 10 million barrels a day as the disruption deepened. That's not a minor hiccup. It's taking out more than 10% of global supply almost overnight. Prices did what prices do when traders see both real barrels missing and the possibility of much worse. Brent crude rocketed from around the $70 range at the end of February to above $100, with some days showing the biggest weekly gains since the early 1980s. In other words, the market has already moved past concerned and into okay. Forgot to read a history book about oil shocks. Now, for us viewers, there's always the same instinctive reaction. Well, we pump a lot of oil now, right? Doesn't that protect us? And that's where this story gets interesting. The United States quietly flipped the script on energy over the last decade. Thanks to shale and sustained production growth, the U.S. became a net exporter of total petroleum, crude plus refined products like gasoline and diesel. This is for the first time in 2020 and has stayed that way in recent years. U.S. crude output hit a record around 13.6 million barrels per day in 2025. Even as exports dipped slightly, net crude imports still fell to about 2.2 million barrels per day, down from 2.5 million the year before. Translation: America still imports some crude, but overall we ship more petroleum out than we bring in. The old picture of the U.S. as totally at the mercy of foreign oil is outdated, though not so outdated that you can ignore Gulf tankers blowing up on your Bloomberg terminal. This shift completely changes the economic incentives. Back in the 1970s, when oil prices quadrupled in the year 1973 and 1974, and then more than doubled again in the year 1979 and 1980, the U.S. was a massive net importer. Those price spikes helped to drive double-digit inflation and nasty recessions, because every extra dollar per barrel was essentially a tax leaving the country. Today, high prices still hurt U.S. consumers at the pump and push up inflation through transportation and production costs. But they also mean bigger export revenues, stronger profits for U.S. oil producers, and improved trade balances for a country that has become a petroleum heavyweight. That's why the political messaging sounds so conflicted. On one side, you have the White House saying, "We want lower gasoline prices to keep inflation under control," and on the other, you have entire states and sectors quietly thinking, "Actually, 110 sound pretty good." Meanwhile, on the other side of the world, big importers like China are scrambling in a different way. China is the world's largest crude importer, and it has spent the last few years shifting a lot of its oil purchases toward Russia. So much so that Russia became its largest supplier, shipping over 100 million tons of crude to China in 2023, ahead of Saudi Arabia. That trend has only deepened. By early 2026, Chinese refiners were taking more than 2 million barrels per day of Russian crude, offsetting declines from India and other buyers. On top of that, Russia has been sending more oil to China via the Arctic Northern Sea route, an emerging North Pole detour that conveniently bypasses Middle Eastern choke points like Hormuz and the Suez Canal, albeit with more ice and fewer beach resorts. So while the Iran-US war is causing chaos in Gulf shipping, it's also accelerating a long-running rerouting of global energy flows away from traditional bottlenecks and toward new, less politically constrained lanes. Now, let's talk prices. As of mid-March 2026, benchmark prices like Brent have been trading just above the $100 mark after spiking from the 70s in a matter of days, with intraday moves that have briefly pushed toward $110 to $120. Some days have seen double-digit percentage gains, numbers we usually only see when something really breaks. Analysts at major houses like Goldman Sachs and Bank of America have already bumped up their average oil price forecasts for 2026. They expect the prices to stay elevated for a while, as the Strait of Hormuz remains partially shut and supply remains constrained. At the same time, a lot of those same analysts are not forecasting a permanent $150 world. They expect prices to stabilize later in the year as alternative supplies come online and the worst-case fears are priced out. So Wall Street is basically saying, short-term pain, long-term gain. But could we actually see that $150 print on your favorite trading app? Absolutely yes, under the right combination of bad decisions. Historically, the all-time high for Brent crude was around $147 a barrel in July 2008, and that happened without a shooting war in the Gulf. It was driven largely by explosive global demand and tight spare capacity. Today's setup is different. Demand is solid, but not 2008 crazy. While the shock is coming from a deliberate supply disruption around Hormuz, if Iran sustains a near-total closure of the strait, keeping roughly 20% of global oil and substantial LNG exports effectively off the market, and if other producers cannot or will not fully compensate, then yes, a spike into the 130 to 150 range is entirely plausible, even if only temporarily. Markets don't need a decade-long reason to overshoot, just need a few weeks of no one knows when the tankers sail again. However, a temporary spike is very different from living in a world where oil sits at 154 months on end. That's where basic economics and politics gang up on the price. For one thing, high prices create demand destruction. Consumers drive less, businesses cut back, and airlines suddenly discover the word capacity discipline. Research on past episodes suggests that major oil price shocks have been associated with lower GDP growth. In some cases, recessions as higher energy costs ripple through the economy. Central banks, including the Federal Reserve, also tend to respond more aggressively to inflation when they believe it is being pushed up by energy. This can mean higher interest rates and slower growth. Another break on sustained triple-digit oil. In other words, 150 a barrel is like a really intense pre-workout drink for the global economy. It gives you a short-term jolt, followed by the very real possibility of passing out on the floor. On the supply side, the longer prices stay high, the more pressure there is for producers to respond. U.S. shale producers can't ramp instantly like they did a decade ago. But at $120 to $150, even higher-cost projects suddenly look attractive. OPEC and its allies, who have been managing production to support prices, would come under intense pressure from both importing countries and their own longer-term market share. Fears to open the taps if prices threaten to crush demand. And of course, the U.S. government still has significant levers. The Strategic Petroleum Reserve, diplomatic pressure on allies, and good old-fashioned back-channel talks to keep at least some barrels moving through alternative routes. President Donald Trump has already shown a willingness in early 2026 to weaponize economic tools. This means applying tariffs on countries doing business with Iran, and that same impulse can cut both ways when high oil threatens domestic political support. A long-lasting $150 environment would be politically brutal for any administration. That alone makes it unlikely we just accept it. So what does all this mean on the ground for the U.S.? In the short run, you're already seeing higher gasoline prices. National averages climbing sharply as crude prices spike. Forecasts show that if disruptions persist, Americans could be looking at pump prices not seen since the early 2020 shocks. That feeds directly into headline inflation because oil prices don't just affect what you pay at the pump. They're embedded in the cost of food, manufactured goods, shipping, and pretty much anything that needs to move or be heated. Historically, the 1970s taught us that big oil shocks, combined with weak policy responses, can help create stagflation, high inflation plus low growth. The good news is that modern central banks have learned at least some of those lessons. And the U.S. economy is more diversified and less oil-intensive per dollar of GDP than it was 50 years ago. The bad news is that $150 oil still hurts, even in a more efficient system. It just takes a little longer to feel like a punch instead of a knockout. There's also a geopolitical layer here that isn't just about today's price chart. The Iran-US war and the closure of Hormuz are happening on top of an already messy decade. US-China trade wars, Russia's invasion of Ukraine, naval attacks in the Red Sea, sanctions everywhere, and a steady rise in what economists call global economic policy uncertainty. At the same time, fossil fuels still provide roughly 4/5 of the world's primary energy. Oil alone accounts for around a third of global energy use, with gas and coal making up most of the rest. That means we've built an insanely interconnected world on top of infrastructure that runs overwhelmingly on molecules traveling through a few narrow shipping lanes. When those lanes get mine-blockaded, or even just heavily insured, the whole system wobbles. The Iran conflict isn't an isolated story. It's another episode in a longer transition from a relatively predictable globalization 1.0 to a more fragmented world where big powers are trying to rewire their energy systems for resilience, even if that means higher costs in the short term. Okay, so with all of that on the table, let's answer the actual question. Will oil hit $150? Well, looking at the current data and behavior of policymakers and markets, we conclude that a short, sharp spike to somewhere in the 130 to 150 range is absolutely possible. That is only if several things line up: continued closure or effective closure of the Strait of Hormuz, more or physical damage to Gulf energy infrastructure, and either a slow or deliberately cautious response from OPEC plus U.S. producers and strategic reserves. Traders love a panic, and the options market has already been signaling upside risks since early this year. So if you see that 150 print in a headline on some random Tuesday, don't be shocked. But a sustained multi-month world of stable $150 oil is, in my view, much less likely. At that point, the pain for importers like Europe, India, and much of Asia becomes politically intolerable. Demand destruction kicks in. Recession risks jump. And even producers start to worry they're killing the golden goose. U.S. domestic politics would likely force a more aggressive response. These include more SPR releases, more diplomatic pressure to reopen shipping lanes, and probably some creative policy gymnastics to shield consumers. And as we saw in 2008, once prices reach extreme levels, the same forces that push them up, fear, speculation, tight balances, can send them crashing back down. When growth stalls and suddenly everyone realizes they overpaid. So the more realistic base case is a period of elevated and volatile prices. For example, hovering somewhere in the $90 to $120 range with occasional scary spikes, rather than a neat flat line at 150. The takeaway is this: the Iran-US war and the Hormuz disruption have already delivered a historic supply shock and pushed oil into triple digits. They've revealed just how much the global energy map has changed. America as a net petroleum exporter, China doubled down on Russian barrels, new Arctic shipping routes quietly becoming normal. Oil absolutely can touch 150 in this kind of environment, but the odds that we stay there for long are lower than the headlines suggest. because such a price would simultaneously trigger political backlash, economic slowdown, and a serious supply response. In other words, the market can absolutely overshoot to $150 on fear. But living in a $150 world is a different question, and one that neither voters nor policymakers are likely to answer with a cheerful yes. Take care.